If the markets have you feeling down, this bit of information should cheer you up. Bitcoin was the best thing you could have bought last quarter. As you can see in this chart of Q3 asset class returns, Bitcoin is at the top with a 3.1% increase, more than double the 1.3% returns on precious metals, 0.2% on cash, while everything else like treasury bonds, gold, corporate bonds, and stocks were all negative. Hello, I'm Crypto Casey, and welcome to another episode of Crypto This Week. Every Sunday, we explore the latest global news stories affecting the crypto markets, as well as the ever-changing macroeconomic environment of the world at large. Be sure to check out our sponsors, Unstoppable Domains, NordVPN, and Ledger. Secure your unique, human-readable crypto wallet domain like casey.wallet with Unstoppable Domains. Protect your data, privacy, and crypto investments by using virtual private network services with NordVPN. And protect your long-term crypto holdings with cold storage hardware wallets provided by Ledger. Check them all out using the links in the description area below. Awesome, let's hit Crypto This Week. As we discussed yesterday, the jobs report released this week will not be well received by the Fed, so interest rate hikes will likely continue through the rest of the year, causing a lot of strain on global markets. One of the issues economists are starting to point out about the Fed's stubborn commitment to raising rates potentially over the next 15 months, if we can arbitrarily start taking their word as bond, is that each change in monetary policy, like a rate increase, takes time for the effects to spread throughout the global economy. Paul Krugman of the New York Times states, "In short, current inflation and employment are basically telling us about the past. We need to look at other data for a glimpse of the future." I'd argue that these indicators tell us that the Fed has already done enough to ensure a big decline in inflation, but also, all too possibly, a recession. Am I completely sure about this? No, of course not. But policy always involves a trade-off between risks, and the risk that the Fed is doing too little seems to be rapidly receding, while the risk that it's doing too much is rising. Yes, but as we explored in this video, the Fed is being pretty overt about their non-data-driven approach and instead are enacting ego-driven monetary policies in a futile attempt to rebuild credibility because they are tired of being mocked by the markets when there are much bigger fish to fry. Treasury's liquidity problem exposes the Fed to their biggest nightmare. The latest bout of global financial volatility has heightened concerns about regulators' continuing failure to resolve liquidity problems with U.S. Treasuries, the debt that serves as a benchmark for the world. With rising risks of global recession, escalating geopolitical tensions, and the potential for further defaults by developing nations, not to mention ructions in a developed economy such as the UK, investors may not be able to rely on treasuries as the reliable haven they once were. The biggest nightmare for the Fed now is that they have to step in and buy debt, said Priya Misra, global head of rate strategy at TD Securities. If the Fed has to step in when it's in conflict to monetary policy, it really puts them in a bind, she said. That's why I think regulators need to fix the market structure. The Treasury Department is working on an initiative to enhance transparency in the trading of U.S. government debt, seen as one step that could encourage dealers and investors to boost volumes. News on that front may come this year at an annual market structure conference. Should be interesting to see what comes out of that meeting. Until then, if the Fed was forced to start buying treasuries again, that is basically QE, or quantitative easing, because they buy treasuries from banks using US dollars, which increases the amount of money in circulation, the money printing that got us here in the first place. So as the opposite, QT, or quantitative tightening, continues to happen alongside soaring interest rates, a strong dollar is wreaking havoc on emerging markets. A debt crisis could be next. That strength has become much of the world's weakness. The dollar is the de facto currency for global trade, and its steep rise is squeezing dozens of lower-income nations, chiefly those that rely heavily on imports of food and oil and borrow in dollars to fund them. Some countries are already in default. Others are teetering on the brink. A sovereign debt crisis could soon spread, derailing fragile recovery from the pandemic and amplifying the likelihood of a severe global downturn. How severe? The Fed's inflation fight has some economists fearing an unnecessarily deep downturn. Rapid rate increases provide less time for central bankers to study their economic effects. Well, it doesn't take an economist to guess what happens when tons of countries and all of their people have no money, can't afford anything, no one is willing to lend to them, and they can't import food and other necessary resources for basic survival. Civil unrest, violence, looting, raping, pillaging, killing, it will devolve into that and already has in some places around the world. And the strange, or maybe not so strange thing at this point, is the Fed seems eager to manufacture the next great financial crisis. Meanwhile, on the regulatory crypto front we've all been patiently waiting for, crypto overhaul fizzles in Congress, leaving industry and investors in limbo. Widely heralded bills have yet to get key committee votes. Much like the Fed's aim to destroy global markets, are all these crypto regulation delays also by design? Probably, as SWIFT sets out blueprint for central bank digital currency network. Around 90% of the world's central banks are now using, trialing, or looking into CBDCs. Most don't want to be left behind by Bitcoin and other cryptocurrencies, but are grappling with technological complexities. The idea is that once scaled up, banks may need only one main global connection, rather than thousands if they were to set up connections with each counterpart individually. Very bearish. And we've already seen some strange parallels with coordinated bank activity around the world. 33 central banks hiked rates in September, following 20 in August and 37 in July. World Bank data suggests this is the most synchronized hiking cycle across the globe on record. And even stranger behavior from financial service providers testing out policies that will absolutely be part of how central bank digital currencies will work in the future, as a new PayPal policy permits company to fine users $2,500 for misinformation. Effective November 3rd, the new conditions will be added to the restricted activity section of the PayPal user agreement. The Daily Wire first reported. Changes include prohibitions on the sending, posting, or publication of any messages, content, or materials that promote misinformation. While the prior policy already forbade hate, intolerance, and discrimination, the new one now also explicitly applies to the specific protected groups and individuals of groups based on protected characteristics. Identities under this umbrella include race, religion, gender, or gender identity, and sexual orientation. And who decides what misinformation is? Why, PayPal, of course. I'm sure they'll be fair. Twitter will restrict your account if they don't like what you post. PayPal has authorized themselves to assess monetary fines for bad behavior. Welcome to the Soviet Union. Well, it looks like that particular policy test didn't last long, as a few hours later, PayPal reverses course, says company will not seize money from people for promoting misinformation. An AUP notice recently went out an error that included incorrect information. PayPal is not fining people for misinformation, and this language was never intended to be inserted in our policy, a PayPal spokesperson told the Epoch Times in an email. Our teams are working to correct our policy pages. We're sorry for the confusion this has caused, the spokesperson added. Weird. At any rate, also this week, Credit Suisse is buying back debt and selling a hotel. The announcement on Friday comes after investors displayed concerns about the financial position of the troubled Swiss bank before it announces its restructuring plan later this month. Thumbnails littering finance and crypto YouTube this week suggested they could be the next Lehman-style crash, but from what I've looked into on the matter, I highly doubt it. But let me know if you think otherwise in the comments below. Also on edge across the pond, the Bank of England says pension funds were hours from disaster before it intervened. The central bank's Financial Policy Committee stepped in after a massive sell-off of UK government bonds, known as gilts, following the new government's fiscal policy announcements on September 23rd. And unsurprisingly, the pound falls again as agency downgrades outlook for UK's credit rating to negative. Fitch takes aim at the apparent conflict between government policy and Bank of England action to fight inflation, warning that it is concerned by the levels of borrowing the Chancellor is likely to need to fund the growth plan. And as if US relations with other nations across the pond couldn't get any worse, China lashes out at latest US export controls on chips. China on Saturday criticized the latest US decision to tighten export controls that would make it harder for China to obtain and manufacture advanced computing chips, calling it a violation of international economic and trade rules that will isolate and backfire on the US. Out of the need to maintain its sci-tech hegemony, the US abuses export control measures to maliciously block and suppress Chinese companies, said Foreign Ministry spokesperson Mao Ning. It will not only damage the legitimate rights and interests of Chinese companies, but also affect American companies' interests, she said. Mao also said that the US weaponization and politicization of science and technology, as well as economic and trade issues, will not stop China's progress. We understand the goal of ensuring national security and urge the US government to implement the rules in a targeted way and in collaboration with international partners to help level the playing field and mitigate unintended harm to US innovation. The Semiconductor Industry Association, which represents US semiconductor industry, said in a statement. So maybe if the US continues to piss off all the other countries around the world, it will make it extremely difficult to implement a global central bank digital currency that they have complete control over, and therefore, the more open, decentralized, and transparent blockchains will be the most popular and adopted. Wishful and hopeful thinking 100%, but let me know what you think about it in the comments below. Yet another brutal attack in the crypto space this bear market. Binance blockchain hit by $570 million hack, exposing crypto vulnerabilities. The world's biggest cryptocurrency exchange confirmed that assets were stolen from the Binance Smart Chain network, the latest in a series of attacks on so-called cross-chain bridges. Binance confirmed on Friday that $570 million had been stolen in a hack of a blockchain it runs that serves as a bridge for asset transfers between networks. The attack on the Binance Smart Chain network highlighted weaknesses in decentralized finance, or DeFi, where transactions are controlled by code. I definitely wouldn't venture to say that Binance Smart Chain is decentralized by any stretch of the imagination, but I will say hacks and exploits happen, and exchanges like Binance and their technological ventures like Binance Smart Chain are huge targets for hackers. At the end of the day, the best and safest way for us to store our long-term crypto investments is by using cold storage hardware wallets. Ledger devices are the most affordable, reputable, and easy-to-use hardware wallets out there, and if you scroll down and use the link in the description area below to check them out, they do run specials from time to time, so be sure to redeem any offers they have by using this link we keep updated for you guys. Awesome. Well, that was Crypto This Week with me, Crypto Casey. If you enjoyed the episode, please make sure to like this video, subscribe to the channel, and click the bell notification to stay up to date on all of the latest videos. So what do you think is in store for the upcoming holiday season? Will it be merry or mayhem? How are things going in your country? Let me know in the comments below. Be safe out there.